This is the current federal tax developments for the week of December the 8th, 2025. Current federal tax developments are brought to you by your state society of CPAs. Ed Zoller is looking at this week's developments in taxes. And this week we have a few things that came up. We'll discuss Notice 2025-68, which involves implementation rules, the preliminary discussion of implementation rules that expect to be found in regulations to be issued by the IRS related to the Trump accounts. We'll also discuss the draft Form 4547 that also came out this week, which will be our method of establishing a Trump account, and a form that can be filed, I should say, with the 2025 returns in order to establish a new Trump account, especially useful for those individuals that have a child born in 2025 who will qualify for the new pilot program, $1,000 deposit into that child's account. So we'll discuss both of those. We're also going to discuss Notice 2025-70. This is some, again, preliminary guidance that tells us what they expect to put out in regulations and some information they'd like comments on even before they do proposed regulations regarding the new One Big Beautiful Bill Act scholarship tax credit. So we'll talk a bit about that. That is the federal tax credit. For those of you in Arizona like me, this is a credit very, very much like the private school tuition organization credit. There's a lot of things that are the same with it, but it will be a federal credit and not a state credit. Finally, we'll take a look at Alioto versus Commissioner, a court decision that looks at a taxpayer who essentially ignored the existence of a corporation or just kind of made decisions on the fly as to where he'd take money from, as well as where he would claim deductions. And we'll find out that being that kind of flippant about what your corporation and ignoring it doesn't really work out well in taxes. Lots of bad things happen in that case. In fact, that is probably like a textbook case, to be totally honest, about all the things people foul up when they don't recognize that they must respect the corporation as a separate entity. Let's talk first, therefore, about the Trump accounts. Notice 2025-68. This is guidance, which is pretty good sized amount of guidance that relates to implementation of the Trump accounts and various other subparts of. And this notice came out on December the 2nd. Now, let's remind you what a Trump account is. Under Section 530A of the Code, enacted by the One Big Beautiful Bill Act, the Trump accounts are basically a traditional IRA that is subject to unique rules, including the concept that this notice introduces called a growth period, and restrictions during that growth period that stay in place until the beneficiary of the Trump account reaches age 18. Now, these provisions will generally apply to taxable years beginning after the end of this year. Because remember, a Trump account cannot be set up or funded until July 4th of next year. That's the earliest date that money can go into a Trump account. So effectively, all the rules apply beginning next year. In order to be an eligible individual to have a Trump account, to be a beneficiary of a Trump account, that individual must be under age 18 must still be under age 18 by the end of the calendar year, right? In this case, of the election, and must possess a valid Social Security number. Accounts are technically organized by Treasury, the Secretary of Treasury. However, an affirmative election to establish the account must be made by an authorized individual. And the notice provides us with the IRS's expected ordering of authorized individuals. And these all are if this person exists. There is one of these who's currently alive, then that's the person that does it. If not, we move to the next one. And the ordering will be beginning with if a legal guardian of the child has been appointed. That'll be the party that is the authorized individual to set up the account. If not, it will be the parent of the child. Either parent could set it up. If, let's say, both parents are deceased, then if there is an adult sibling of the child, that person can set up the account. That's the one to set up. And if not, then we go to the grandparent. And presumably, we've probably exhausted now at this point who could be there. Certainly the order they put in. Whether the regs will provide a catch-all after that, potentially likely, I suspect there will be some sort of catch-all there that's in that regard. But usually a court will have stepped in at this point for a minor and will essentially have assigned a legal guardian. Even if that is, let's say, their aunt, their uncle, whatever, they'll assign that up for it. Now, like I said, we have this concept called the growth period. The growth period is essentially the time period, until the child turns 18. And the growth period has some special rules. Number one, there is an investment mandate during the growth period. Unlike an IRA, this thing cannot invest in everything an IRA can. We know there's some restrictions on an IRA, and those restrictions would still apply to this. But on top of that, we have way more restrictions in this case. The funds must be invested solely in what are called eligible investments. Generally, low-fee mutual funds and ETFs, exchange-traded funds, that are, tracking a qualified U.S. index. The only index directly mentioned in the statute is an S&P 500 index. They do tell us that you also cannot use an industry-specific or a sector-specific index. Now, the notice tells us that this index must be, old law said primarily composed of U.S. equities. The law now says it must be 90% U.S. equities and generally would not be any debt funds. Also cannot be cash or money market funds. They're excluded except for a minor amount that could be in a temporary transactional fund, right? So in essence, when the money first goes in, it can stay in cash, but with the idea being it needs to be quickly moved into a qualified security because more than one security could be offered, more than one qualified investment could. So it's going to be moved there. Now, distributions, the notice points out, there is a near total lockup of the fund until such time as the beneficiary turns 18. Mom and dad do not have access to this fund no matter what. There is no hardship distribution. I don't care how good your story is. There is no way to get this money until the child turns 18 because it doesn't matter if the family has been abandoned on the street and is starving. Well, this money is not available for that. Now we're going to say there really is nothing there to do it. You also cannot simply close the account to force money out. In essence, once this thing is established, these funds will stay in a Trump account until the child turns 18, unless, there's a qualified rollover to another Trump account. You can do that. Or an ABLE account. Or, an ABLE account only works when they turn 17. There's like a 1-year period. You could move it to an ABLE account. So when they turn 17 that year, we can make the transfer and roll to an ABLE account, assuming the child's eligible for an ABLE account. Otherwise, the only other way it comes out is the child dies. And per the law, if the child dies, the money comes out immediately, either taxable to the child's estate or taxable to whatever named beneficiary or beneficiaries, multiple, there are for the account, right? So basically, it is a time-locked vault. You cannot remove anything. You can put things in, right? And we'll talk about the contribution rules here. And we are strictly limited to contributions, right? And we're strictly limited in what we can invest in until the child turns 18. So very much a limited growth, very, very restricted. Obviously, the idea of this when it was proposed was we're not going to let mom and dad foul it up, right? By doing these odd investments, whatever the hot thing becomes tomorrow. I don't care if it's gold or if it's more crypto or if it's NFTs, which came and went very quickly, right? They can't be in that. They're going to be in stocks. And it's going to be U.S. equities, and it's got to be a broad index, low fees. Those are all required. Now, contributions, what we have here is there are certain contributions have no cap. Those contributions that will not impact how much you can put in will include pilot program payments, right? It will also include qualified general contributions. We'll talk about those a bit later because we have one now, that has been proposed. It'll be fairly broad, so we want to discuss that very quickly, which can come from governmental agencies or nonprofits, and rollovers into the account do not count. Now, you can only have one Trump account per beneficiary. So essentially, I can't do a partial rollover of the Trump account and have the, let's say, like 4 or 5 different accounts. All accounts have to be together because the trustee is going to have to verify that we don't go over the contribution limits. That'll be part of it. Now, any contributions from other sources, right? These are funds from the parent or the beneficiary themselves. And these do create basis, right? There is another source of contributions, which are Section 128 plan employer contributions. They're excludable from the employee's business or employee's income, right, on their employer. We'll talk about them in more detail, how they work a little, in a second. But any money that goes into the child's Trump account from the employer contribution program under 128, that does not create basis. Now, there was an article in Tax Notes this past week where there was a discussion in the benefits arena where a lot of attorneys that handle benefit programs have noted that, this guidance is out there, but so far they're not hearing about a lot of employers who seem to be moving toward doing 128 programs. We'll just have to kind of keep an eye on them and watch them. They have some, but not all of the flaws of the 127 programs, that which are for the programs we talk about when you're paying tuition of the employees, ways that you can have issues with not ever being able to make the anti-discrimination rules work just because of the makeup of your employees. And one real concern with these programs is that, let's say you've got a lot of employees who are single, young, have no families, no kids. Then you have the ones that are, the ones that have been around more stable. They have higher earnings. And the problem is you may very well find that all of your highly compensated, or a good chunk of them have children. And especially if you fund this through a 125 plan, which you're allowed to do, mainly allowed to do, you're going to find the problem is that, all of those singles aren't putting anything in. And when you run the math, you're going to have a discriminatory plan by the very nature that we've got these single individuals who have no kids or even young marrieds with no kids, right? Who aren't getting it because there is no kid to put it in for. But that's skewing your numbers and make it discriminatory. So as I say, it becomes kind of a mess. Now, no contributions to this plan are deductible. Because again, remember, they're a quasi-IRA, and that means they work like an IRA unless the law provides otherwise. Now, we are told right away these are not Roth IRAs. So you think, well, 219. 219 says I get a deduction, right? To the extent I have compensation. And no, all the deduction provisions of 219 don't apply during what's called the growth period, right? We're waiting for the kid to turn 18. So during the growth period, they don't apply. But unlike standard IRAs, there is no requirement that you have compensation to be able to receive contributions. And contributions to this program do not reduce your ability to make contributions to IRAs, to standard vanilla IRA programs. There is no limitation there. Okay. What's the contribution limits and the timing? For 2026 and 2027, the maximum amount that can go in, other than those excluded options, right? The pilot program, the general contributions from the not-for-profits and governments, and any rollovers, is $5,000, right? And it will be adjusted for inflation beginning in 2028. Now, this cap applies to the combined total of any employer contributions that went into the account. So they do reduce how much can also go in there, plus any private other contributions. Now, again, basically the custodian of the account is going to be responsible for assuring that not more than $5,000 gets in. So that's why you can only have one of these accounts, right? No more than $5,000 goes in. Also, Section 219F3, which provides that as long as you make your IRA contribution by the original due date of your individual return, You can treat that as, let's say you put it in after December 31st of this year, but before April 15th of 26, you could treat that as a 25 IRA contribution. That rule will not apply for Trump accounts. So that means the money has to go in by December 31st. There is no ability to throw it back into the prior year, because you made it before April 15th. The law provides that exclusion. They also clarify that, which was not totally clear in the law, but the Section 128 plan contributions from an employer, to its employees and to 128 plans, or to 530A Trump accounts for them or their dependents, that is limited to $2,500 per employee, not $2,500 per dependent. So if an employee has 5 children, that's not $2,500 per kid. That's $500 per kid, right? They can split it. Basically, if they're going to do it for each of the kids, it's going to be over 5, and it'd be $500 for each, not $2,500 for each. So that was a clarification that people were still trying to figure out how the law read on that, and we're going to do that. Now, also, the employer's $2,500 contribution reduces how much can go in for the private contributions. So again, if the employer, let's say you have an employee, has 1 child, 1 Trump account, the employer puts in $2,500, only another $2,500 could be put in by the parents or any other party into the kid's account, because that's all that's left. Even though we don't get basis for that because it wasn't included in the employee's income, so there's no basis, but it still reduces how much can go in. Now, the amounts that go in on the other private contributions do increase the basis in this when the kid gets it. And the trustees are charged with keeping track of that basis. Okay? It's not like a Roth IRA where, the trustee doesn't have to worry about the basis. This time I decided, because people get that so fouled up, and it'll be for a kid, and we know the records will be missing. The trustee has to provide the kid with information on the basis of the account at the time the kid turns 18, and it converts, it's no longer in the growth period. So we have that background. Now let's talk about the special case of qualified general contributions, or third-party funding options. Now, when I saw this in the code, when I saw the OBBBA, I still try to figure out who exactly was this floor, because it requires you to basically be a not-for-profit organization or government. You have to agree to fund all eligible accounts in a geographic area. There have to be at least 5,000 accounts in that geographic area. And you got to kind of fund every one of them, or on a non-discriminatory basis. So there are some things you can do, but it's limited. And I was like, okay, who's doing this? And we now know who's doing it. In essence, basically the Dell Foundation for Michael Dell and his wife has pledged $6.2 billion to make a qualified general contribution. Okay, and we'll talk a little bit about that. You can see that on here, but let's talk about them in general first. So a qualified general contribution could be funded by a state, a tribal government, or a 501c3 organization through the Treasury Department. Now, this money goes to Treasury. The money does not go directly from the charity to the Trump accounts. It goes to the Treasury, who will be given the information about the geographic area and any allowed conditions on who can get these funds. And so Treasury will look to that. Treasury will then be the party to put the money into the funds. Now, a qualified class must be a specific cohort, for example, all beneficiaries in a specific state or born in a specific year. And you're going to find out, and those are really the 2 kind of things you can do. You're going to find out that the Dell contribution is going to use a geographic area test, and it's going to use a born in a specific year test. It's not phrased initially as a born in a specific year test when they explained it, but when you think about it, it literally is. It's got to be somebody who's not born between 2025 and 2028, because those qualify for the pilot program contribution, and because of that, they can't get this Dell contribution. Okay, so we're going to have that. Treasury is expected to roll out the full application process by July 4th of 26. However, we already have this announcement about the Dell program. In fact, the White House put in their press release about this. So we're presuming that the Dell program, well, it can't yet be approved, but it kind of is approved. Sits us in a weird place as to where, how exactly this works. At the same day they announced that they expect to finally get a program to approve these, they're telling us we've already got one, but we don't have any program to approve it. There are a couple of issues with the Dell program that hopefully will get explained. Unfortunately, as it stands right now, I don't know of anyone who has an actual copy of the actual statement of what Dell said, or I should say, of how this thing would be funded. And there's no applications yet, so we don't really know certain details. And there is some concern, at least, about one of them as to how it's going to work. Okay. Now, these exempt contributions do not count toward the $5,000. So you're not going to reduce the amount you can put in your kid's Trump account for let's say for 26 by signing up for the Dell contribution. You'll get Dell's contribution, which would be a maximum of $250, and you can have that go in the account. Plus, you can fund up to $5,000. And there may be other of these qualified general contributions in play. So we'll see who else signs up to do it. Certainly, there are people. In fact, there is, I believe it is, was it Cory Booker and Ted Cruz, which is an interesting combo. Both had signed on urging, really high net worth. I mean, Michael Dell is really high net worth individuals, to go into funding these things for either various areas, specific areas, or do something like Michael Dell did and kind of go quasi nationwide. So there is a push to get people to sign up for this. So we may see more qualified general contributions. We'll just have to see if other programs go. Right now, the only one that anybody's announced I'm aware of is the Dell program. Okay, for those interested in the Dell program, and this gives you kind of an outline how one of these will work. In this case, Michael Dell's foundation is agreed. In essence, they're going to contribute $6.2 billion, and Treasury is to use this to provide for those who opt in a $250 contribution to what's called qualified recipients. They have to be 10 years old or younger. They must reside in a zip code that has, and the problem is on the White House site, it just says average income. The Dell Foundation site doesn't really mention this at all. But I've seen a lot of articles, and they kind of split half and half. Half say that this means qualified household income, and half say it means qualified family income. Basically, or I should say, the mean family income, and it's not average, it's mean. So make sure, median, let me get that right. We're looking for a median family income of $150,000, a median income. Got to be careful how I word this. Looking for a median income of $150,000 or less in the zip code. Now, there are two ways that likely one of the two is the meaning. And there is a third way that if you really took it literally, what the White House says, you'd say the meaning, but there's not really any good way to get that stat, as far as I know. The main way that seems to be going here, and I'm going to guess one of these is true because they're kind of related. We're going to look for what's the difference between family income and household income. Household income includes everybody in that area, right? So the big thing is it will include single individuals. It will include unrelated individuals living in that household. So if you had 6 unrelated people, a bunch of roommates, you take the income of those 6, right? If you are a single individual, right, in essence, you're the person living there, then it's going to be your income. If you're a married couple, and let's say you're there with your 2 kids and with, and with, let's say, the parent of one of the spouses, then all of them will be part of household income as well. However, family income only considers households that have more than one person and only the people who are related inside that household. So if you had a household of, let's say, the old traditional nuclear family, mom, dad, and the two kids, then the income would be, mom and dad's income. Presumably the kids too, if they're earning income, would be household. It would be basically the family income. Family income generally, because it will include families, and therefore there has to be more than one person in a household, almost by definition, will be higher than household income. So the mean family income or median family income will be higher than the median household income. That's expected. And again, note that we're talking here about median, not average or mean. Median is there are exactly as many households with more income than this that reside in this zip code as there are with less than this. And quite often, the mean is much lower than the average. In the zip code I reside in, there is a big difference between the mean, basically the average income in the area, which I believe is close to $140,000, and the mean income, which is around $90,000. And the key difference is that it includes a lot of very diverse areas. 1/5 of the people in my zip code, 1/5 of the households, have incomes of in excess of $200,000, right? Which puts them on the upper end. However, there are a lot, and they're geographically separated to you. I know where these areas are inside this zip code. Some of them are very high wealth. In fact, arguably some of the most expensive real estate in the city of Phoenix resides in this zip code. And some of the highest and wealthiest people in the city of Phoenix. I'm not counting Paradise Valley or Scottsdale in this thing, just city of Phoenix. But, they are very, very wealthy and probably on the wealthy side that's only going to be beaten by the Paradise Valley people living on the other side of Camelback Mountain. In essence, this is the south side of Camelback Mountain, got the north side of Camelback Mountain. My guess is the wealthiest people are going to be a lot of very, very wealthy people there. So part of that's inside the zip code, but there are other areas that have a lot of small houses and apartment complexes with very, with people, with young individuals starting out, etc. Those single family households makes for a wide difference. So running some preliminary tests on Arizona, guessing both ways, and using various methods to try to come up with these numbers, it does appear that there aren't going to be a huge number of zip codes that don't qualify, but there definitely will be some. And I would expect we get to places like California. I would expect Marin County to be obviously, way over the top. And there are definitely counties, I would expect that many counties, in wealthier sections on the coast are going to definitely be outside of this category, but others will be in. Okay, so the idea is that the Treasury would determine this, and these individuals had to be not eligible for the pilot program. So here's how it goes, right? Age 10 or younger, not eligible for the pilot program means, right, and I don't know what the age 10 cutoff date is going to be. That's the other question about Michael's program. And again, we don't have the text, so we can't tell you for sure how it's going to work. But the theory would be that you're born, let's say that the cutoff was, as of today, you must be 10 years or younger. So we're sitting here, let's say, in early December. This is being recorded on December the 6th. So basically, you had to be born let's say, actually, we're just going to use the calendar years. So we're going to go back and say you got to be 10 years old or, got to be 10 years old or younger on January 1st of 2026. So what that means is that we're going to be looking at people who were born in 2016 or 2015. It would be at that point, I believe. Because they'd still be 10. They're going to turn 11 in 16. I think would be there. Yep, that's going to work. So people born in 2015 through 2024. those children would be eligible for this contribution under age 18, which they're going to automatically be. They'd be eligible to receive this Trump account. Again, I don't know that, in fact, 2015 will be the cutoff date. I'm just going to work with that for now. So therefore, that qualifies as the one restriction you'd have based on the year born. The second restriction allows you to do it by geographic area. And the zip codes form the geographic area. Now, the only quirk, and this is one of the concerns, is according to the notice, the Treasury will not, for now, accept a geographic area that is any smaller than an entire state. Well, I've already know that all of Arizona is not going to be covered by this. We have zip codes that are above that limit. So it would appear that Michael Dell's couldn't be done that way until Treasury finally decides to start accepting smaller geographic areas, which I guess will be in the regs. But again, it's a little confusing why we're saying we're accepting Michael Dell's. We don't have an application program yet. And in theory, we don't yet have a way of doing anything smaller than a whole state. So let's just say there is information to come about how the Dell program is going to work. So we'll keep it that way. But that is out there for qualified general contributions. Finally, they also tell us about how we're going to transition into the growth period, right? The growth period ends when the beneficiary turns 18. 18th birthday, bingo. The growth period is now over. That becomes then the account will be subject to traditional IRA rules, but unless it is moved to a traditional IRA account, it will still be considered a Trump account for purposes of distributions. And that's interesting. Remember, basis. Basis among IRA accounts is aggregated. Traditional IRA accounts is aggregated. We take a distribution, we get a proportionate amount that comes from our basis, and the rest comes from the other balances in the account. And that's also important if you're trying to do a backdoor Roth, that you don't want to have traditional IRAs. If these funds stay in a quasi-Trump account and aged out of Trump account is treated like an IRA, way more like an IRA, but it's just not considered for distribution purposes to be an IRA, then you could still make the backdoor Roth. However, if you roll it to a traditional IRA, and the notice does tell us that a custodian can do this, or the custodian provides that, the funds are going to go into, or will automatically convert, the account will be converted or rolled directly into traditional IRA account once the person turns 18. And accounts are allowed to do that. They're allowed to make that a condition. Then it will be a traditional IRA account. While it is still a quasi-Trump account, it also cannot receive SEP IRA or, if enough time has passed, simple IRA funds. So, we have that little problem too. So anyway, it's a weird category we're going to talk about here. Okay. Now, otherwise, it's subject to the standard taxation for IRA distributions, which means it certainly seems that the early distribution penalties would apply if there's no exception. So, the kid turns 18. Now they want to take all the money out and buy the Porsche. They will pay regular income tax on that to the amount the balancing account is in excess of their basis. And secondly, they're going to pay the 10% early distribution penalty, right? Because it becomes an IRA. Well, kind of. It's almost an IRA. I think that's how to do it. We start out with a program where it's something that is very, very different from a standard IRA. And then once we get to 18, we get to something that's very, very close, but not quite a traditional IRA. And also, this makes clear trustees are required to track and report the source of funds, continually through this to ensure accurate basis calculations upon distribution. So that's also a requirement. Now, along with this, we got a copy of a new form. This is a draft of Form 4547 along with its instructions. And this is where we make elections and, to set up the account, to claim the basically the pilot program, distribution, also where we essentially, file to claim the account. So this is now on the IRS's draft form site. December 3rd it appeared. And what it is, let's talk about it generally. The purpose of new form 4547 is to elect to establish the Trump account and or elect to, receive a pilot program contribution. That could be if you already had set up the account, somehow then made the election, you could file it to then elect to put it in. So therefore, we're going to say and or, it appears, is how it works. Now, the IRS is strongly recommending that the 4547 be attached to the authorized individual's e-filed tax return, current year tax return, okay, which would be likely the 2025 return. So 4547 is something you should note right now. If your client has a new child, they had a child born in 25. Remember, we always ask about that because you got to add the dependent. If that's true, then you've got this conversation of, do you want us to go ahead and set up the Trump and ask them to set up the Trump account, which would in theory be formed on July 6th of 2026, as long as your return was processed by them, right? We get that in there, which may put some pressure on you to get certain returns processed earlier. If people go on extension, they still would like to have it in there in time to get the money right up front when everybody else is getting it. So we do have that. You'll go ahead and you'll file this form, right? You can file it on paper, but they suggest you don't. They do plan to have a portal set up mid-2026. We know the website right now, trumpaccounts.gov. Right now, it just allows you to sign up. Last I checked, at least, didn't check it this morning. It just allows you there to put your email address in so you get news about Trump accounts, but right now, nothing else you can do there. In theory, eventually, that site will let you go ahead and make the elections there. And if you can't do either one of those, you didn't do it electronically with your return, you don't feel like going online and doing it, or you feel like you don't have access to that, you can file it on paper, but they do strongly suggest you don't. And the draft form instructions, the draft form accommodates elections for up to 2 children. So you would attach additional forms if there are more than 2 children for which you're making the election. The basic form, if you're watching the video of this, is on the screen. It's available on the IRS's draft form site. Essentially, it has a part where the parent, guardian, or other authorized individual gives their information, the party that claims they are authorized to set this up, and they will eventually certify they're authorized to do so. So, you'll have their information. Then in this part below, you'll have the child's information, name, address, etc., and certification that they qualify for these setting up an account. So we have that part in. The pilot program election is a separate issue, but it's on that form. That form allows you to go ahead and just set up the account, or you can make the pilot program election. My guess is, again, for your clients who had children born in 25, you're probably going to make the pilot program election and have an account set up for that child and potentially set up accounts for their other children. That's going to be especially true if they plan to claim the $250 from the Dell contribution or any others that might show up. Okay. The pilot program is a $1,000 contribution from the government directly put into the account of the beneficiary. The eligible beneficiary must be a U.S. citizen born between December 31st, 2024 and January 1st, 2029. Obviously, children born in 25 who are U.S. citizens will meet that requirement. Will need a valid Social Security number, must have been issued prior to when you make the election date. You want to make sure you got that in play. You must anticipate, for authorized individual, to make the pilot program note, has to anticipate they will be able to claim this person as their qualifying child for the tax year of the election. So it's a little bit different than who's allowed to set up the account. We got this other side effect here that the person setting up the account has to be the one that will claim that person or expect to claim that person as qualifying child for the year, essentially the tax year when you made the election, which would be 26, presumably. And again, no pilot program funds could be deposited before July 4th of 26 because the accounts can't be set up. The portion of the form that has this information, again, you can see it on the screen if you're watching the video version. It just asks what you would expect to be asked here. The name, Social Security number, date of birth, relationship of this person to the authorized individual. Basically the home address, If that's the same as up for the authorized individual, you can check a box. Otherwise, you're going to fill in the detail about what it is. And also, finally saying, make sure check the box if you're authorized to open the Trump account. And that's basically, yeah, you need to check that or it won't, you have a problem, an account will get open. Also on here is if you're opting into the pilot program, you'll check the box, but you're checking it. And essentially that you want you want to get the $1,000 and have that go in. And again, you elect that on a per child basis. If you have one child born in 25, another child was born in 24, you can only elect the pilot program for the child born in 25. You can set up an account for the child born in 24, and that account may receive the Dell contribution, but it won't receive the pilot. The pilot is the 1,000. We have a little bit more information on the mechanics of the employer-sponsored program. We are told it can be done by a cafeteria plan, but an employee can only defer. Cafeteria plan, I can take part of my salary, put in. So I could designate up to $2,500 of my salary to go into the cafeteria plan for use for the employer 128 program to fund Trump accounts. But that can only go in for Trump's accounts for my dependents. If the employee is under 18, has a Trump account, well, employer funds can be used to fund that account. If the employer is putting the money in themselves, they could go ahead and put the money in for that child. Because of provisions in the cafeteria program, you can't, in essence, defer the income, but then effectively just have that cash pop up into your account. It can't be that sort of saving vehicle, right? Because this makes it look like an addition to a 401k type structure. So there is that quirk. The IRS says the regulation provide you can only push it into your dependents accounts. If you, the employee, are under age 18, you cannot use a cafeteria plan to fund your account. Rather, only if the employer is funding accounts directly, which most I expect won't, is set up such a thing, would you be able to get one through a 128 program? So that's really key there to know about that. Employers must explicitly designate 128 funds to the trustee. So the trustee has to know it's come from 128 plan. When it goes to the trustee for the Trump account, it's got to be designated as 128 funds. Because remember, those we don't get bases for. They have to be separately accounted for. But they do reduce the contribution, so they're a really odd category that the trustee has to track. And again, they're reported separately. So because remember, we have to, reduce our amount we could contribute otherwise by whatever goes into the account from the employer plan. Finally, part 4 of the form requires signature by the individual. You consent disclosing account's existence to other eligible individuals, the other parent, right? So if there's another parent, they're going to they can be notified about this account. This can't be kept secret from them. You've got to certify you're authorized on a specific priority hierarchy to make whatever you're doing, the election to fund the account or the election to take in to accept the pilot program money. And realize right now, always a draft. Don't send this form in. Please don't send it in. We have a draft, but that's all it is in a moment. Like I said, now this does have a December 2025 date on it. Therefore, we're expecting it to go in a final form in December. Again, they don't expect the website to be up until 26, and they're not going to accept e-filed returns until sometime probably close to February. February of 26 is betting right now. So, I guess you could file the form on paper when it comes out initially, but they are suggesting you don't do that. And I think you're going to slow things up if you do. So I just say get ready for it, and we'll see how things go. Next up, let's go to another thing put in by OB3. This is the On Big Beautiful Bill Act Scholarship Tax Credit added to the code. Notice 2025-70 issued on November 25th outlined how this program is going to work. So let's discuss this new scholarship program. Okay, this is a non-refundable income tax credit for qualified cash contributions to a scholarship granting organization. Now, an SGO grants scholarships, we'll discover, essentially to private schools, or pays for certain expenses for children in private schools, right? The maximum credit for an individual will be $1,700 per taxpayer per taxable year. So that's a max. You max out at $1,700. For those here in Arizona, I think this will be structured as something in addition to the Arizona credits. So it'll be a federal credit. And because we are going to lose the credit by any amount, we're going to reduce it by any amount, any credit allowed on a state tax return for the same contribution. I think that wording indicates to me that I can give $700 to an SGO and then go ahead and give, my Arizona limit for the year to a standard Arizona private school tuition organization. And if that private school tuition organization is also an SGO, which I think will be very much likely in Arizona, as long as I make separate contributions to it and specify separately where it goes, then we'll be fine. It's not as if having used up $1,700, let's say having used up more than $1,700 on Arizona, that's not going to disqualify me from getting to $1,700 on the feds. It's a separate run. So basically, if you do get a state tax credit, let's say you're in a state that's not 100% credit state. Let's say in your state you get a 50% credit for giving to these organizations. Then you gave $1,700, you claim it on the state return, you would reduce your federal contribution. My guess is in most cases, you're just going to take $1,700 on the federal, and then if there's a separate state program, you'll just use that. But be careful. We got some issues coming up here. Any excess carryovers limited by the standard rules under Section 26 of the Code carries forward for up to 5 years on a first-in, first-out basis. You are not allowed to claim basically a charitable contribution deduction for any amount on which you claim the credit. So basically, the $1,700. When you make that $1,700 contribution to the SGO, while the SGO is a charity, you're going to get no deduction for it. And unlike the state tax credits, this is not going to count as a deductible tax because it's just literally not. It's paying federal taxes. There's never been a deduction there for that. So essentially, you're going to basically get, you paid $1,700, it went directly against your income taxes, but that's all that's going to happen in that realm on the federal side. Now, an SGO, Scholarship Granting Organization, is a 501c3 organization that cannot be a private foundation. Right? The organization must maintain separate accounts exclusive for the qualified contributions they receive to prevent any sort of commingling. And the SGO must be listed by a participating state that is voluntarily elected into the program to police it. That's literally what they're going to be doing. Is it an unfunded mandate? Well, kind of, right? In essence, people in your state can't get this benefit unless the state basically sets up the program and funds the program to be kind of police the activity. Now, the operational requirements for the SGO, it must spend not less than 90% of its income on scholarships for eligible students. And it's got to, and this is a little different, it must provide scholarships to more than 10 students who do not all attend the same school. So I've got to support 2 schools and at least 11 students, or I can't be an SGO. As well, the funds must be used solely within the state where the SGO is listed. So the funds you can't go fund scholarships. If you're listed in Arizona, you can't go funding scholarships for students in Hawaii. You're listed in Arizona, it's the only place you're listed. You can't give money to a kid to go to Hawaii and be covered by it. Some other prohibitions: you cannot have any earmarking of funds for specific students. There was a lot of controversy around practices related to that, including attempting to name your own kid. And then when that got stomped out, then we just had parents doing cross, designations. So I designate your kid, you're designate mine. So on the federal side, they simply said, we're not going down the designation route because we just see that as a as it's going to be misused. So we're just going to say no designation and no awards to disqualified persons. That would include things like families of the selection committee are not going to be allowed to do it, and whatever else gets defined. They're still working on that for whatever will be in the proposed regulations. Student eligibility and verification. Number one, the expense must be for a qualified elementary or secondary education expenses. Tuition, fees, similar things are in there. The household income cannot exceed 300% of the area median gross income. We got some defining to do and how we're going to make sure of that. The priority. A fund is allowed to prioritize basically its scholarships first to those that previously received a scholarship from the organization, and then to siblings of its prior recipients, right? Its recipients. So it's able to do that. That's the only prioritization, I should say, you're allowed to do. Now, the IRS seeks comments on how these organizations should verify household earnings. Should they obtain a 1040 from everybody before they can do it? How they verify the family's not over the 300% of area median gross income on a household income basis. There also is, the IRS is requesting comment on multi-state issues, right? Now, for income, the IRS is proposing income for the 90% test includes all income, including unrelated business income, not just contributions. Also, for multiple state-owned organizations, there's a question here. How do they apply the 10 student and 90% spending rules? Do we do an aggregate test for the SGO looking over all the states it operates in? Or do we have to test at each state level for this, right? And so that's also, do we do that state by state? Do we do it as a whole? They want clarification which way they should do it. Because the state verifications states that state cannot, if a state sets up to be basically their verifying entity, they cannot simply rely on self-verification where the organization says, "Oh yeah, I swear, we're actually following all the rules." We need to have more. We need to do more work than just accept their statement. So the IRS wants to know, what exactly should the states do, right? Again, they must certify under penalty of perjury that these people qualify. What's going to be an acceptable amount of evidence to have gathered for the state to sign the verification? Because again, under penalties of perjury means that this is a criminal statute if you in fact are breaking it. So they're going to want to know how that works. And so these are all asking for issues. Finally, reporting and donor notifications. SGOs will likely be required to report donor TINs to facilitate IRS credit matching. Donor notice, SGOs may need to inform donors of the $1,700 cap and the state tax credit certification reduction rule, I should say. Also, comments need to be received by December 26th. So, coming up in a few weeks here, right after Christmas, got to have your comments into them. And, we're kind of like looking at this. We kind of got some inspectors who are checking it, comparing to the actual thing being done by the SGO. Finally, let's take a look at Alioto, I should say, versus Commissioner. This is Tax Court Memo 2025-125. This case came down on December the 4th. What was the background of this case? Well, taxpayer is going to disregard the corporate form entirely. Something we see quite often, unfortunately. You ever had those clients come in, especially new clients, you find out they've been kind of ignoring everything about the corporate form forever. Well, in this case, the taxpayer failed to basically pay any attention to the existence of his corporation, which was Probity Enterprises, Inc. Now, some of the things he did, he went ahead and used corporate funds to pay for his personal expenses, right? And he's going to claim that, no, that's not income to him. And then he also went ahead and tried to deduct corporate payments on his own 1040 rather than on the corporate 1120. He moved them onto his personal return. So he was very inconsistent with where things and how things got reported. The IRS basically said that the unreported wage, they had unreported wage income, he had a number of constructive dividends, and he had capital gains on selling stock. All of these were messy transactions, all of which he had these weird explanations about, why there wasn't a bad tax result from them. Right? At the end of the day, the court basically has ruled for the IRS on all of their main issues. So let's talk about this. First thing the court turned to was the concept of a duty of consistency problem. Now, generally, the courts will say that a taxpayer who has, let's say, controls related entities, you got to be consistent. You can't take a deduction for a payment to you on one return, but then swear that it wasn't really. So, for instance, you can't claim a deduction for salary supposedly paid to you on one return, on the entity return, but then turn around on your individual return and claim, oh, no, that was a loan. Yeah, that's inconsistent. That was basically what went on here, right? The corporation, which he had full control over, had deducted 3 months, had essentially, we're talking about this was, get it right, $89,000 in transfers to him were non-taxable expense reimbursements, under accountable planning claim. Now, the corporation, which was directed by, this taxpayer, had deducted these amounts as simple officer compensation in a prior audit. Now, he's saying, oh, they're there, or I need to pay them back, etc. But no, right? They're not compensation to me. Well, the court held a duty of consistency problem here, right? Under what's a quasi-estoppel rule, right? You cannot benefit in a later year from an error or contrary position on an earlier return that's now closed. So he was basically stopped from recharacterizing the payments as a loan or as a reimbursement under an accountable plan. Saying, nope, you treat them as wages. You got to benefit on your corporate return for taking this deduction as wages. They're wages. We're just going to keep stuck with that. They are wages for this purpose. Now, the corporation paid for Mr. Alioto's food, fuel, and other living expenses. General rule, any economic benefits conferred on a shareholder without the expectation of repayments equal constructive dividends. Obviously, that was what the argument was happening here. Now, he said again, these related to advances and payments on the accountable plan. But the court said, here's the problem. Under the code and regulation, an accountable plan must have a basically plan document. Also must show that you either demonstrate the business connection for each amount you got, or you have to return those funds you can't document. None of that was going on here. So the court held there was not a valid accountable plan in place. Therefore, there was no deduction. The corporation couldn't claim these as a deduction, and the taxpayer had to claim them as constructive dividends. Then he did a weird set of transactions where he claimed to sell high basis stock. And he had both his original stock, which was 1 penny per share, but then he had this later issued stock that he claimed to have purchased from treasury stock, where he claimed that he had paid $500,000 for this. What he really done was he issued a $500,000 promissory note from himself to purchase treasury shares from the company, right? He then essentially sold some of these shares to other family members, and he would report there was no gain on that sale when he pocketed their cash. Now, the court found that you really obtain, and they went back to the Alderman case, if all you do is sign a note, create a note, right, in making your own note, and then you exchange that note that you just created for stock or any other asset, there is no real basis there, right? You just self-created a note that you exchanged for that item. So based on Alderman, you don't have any basis in that until you actually make a payment of principal on that note. Then you pick up a portion of that as basis for these shares, how many shares in total were covered by the $500,000 versus how many were sold. But in this case, not only did he do this, didn't really have the backup there, but he also had the right to offset the note against deferred income. So in essence, they found there was actually no debtor-creditor relationship anyway. And so essentially they ignored this and effectively treated the full amount he received as payment, from his relatives that were buying shares in this company as income to him, right? Fully taxable income. He also took a number of corporate deductions on his own Schedule C, right? He claimed a number of Probity's operating expenses on his Schedule C so he could zero out his tax liability. He wanted to do that. So he just took some off the corporate return and reported them on a Schedule C on his return. Now, the court said this goes back to the Moline Properties case, right? A corporation is a separate taxable entity, and generally only it can claim a deduction for its expenses. So a corporation cannot deduct corporate expenses they pay personally. They're either capital contributions or loans. Now, if they're also employees and you can show, that it was an employee business expense, which means you got to also consider whether he had a right to be reimbursed or not, then maybe you get them. But remember, there's no deduction for that anymore either. So it's not going to be on a Schedule C. It's going to be for you as an employee. So remember, as an employee, it couldn't go on Schedule C, but as a non-employee, any expenses that you paid, even if you did have an agreement that you're going to pay for these expenses, rather than the company pay for them, that's still going to be an employee business expense. And for most people, very, very few are exempt from this. It's not deductible, right? We can't get miscellaneous itemized deductions anymore, which is what that would be. So in essence, you've got to properly report and pay attention to corporate formalities. Therefore, these deductions that related to the corporation are simply going to be corporate expenses, right? To the extent he paid them personally, he would need to look to get reimbursed by the corporation. They're not his, they're not related to his, they're not related to his own personal business outside the corporation. So some key takeaways on this. It's very important to strictly adhere to the rules, especially those under 274D, for travel and vehicle expenses, because, he failed that too, not unexpectedly. You got to make sure you're consistent. If your client has a bunch of entities they control, you got to make sure there's consistent reporting for any transaction that affects both of them. And normally, they often have transactions that affect them and their personal return. For instance, obviously, my accounting firm is claiming a deduction for wages paid to me, right? The accounting firm I own shares in. That means I need to report that on my personal return. I and my partners cannot take deductions on the corporate return for salaries we claim were paid to us and then claimed, they were just loans when we get to our personal return. They're loans, so they're not taxable. It's like, no, that's an inconsistent position. And the IRS has a right to enforce a consistent position. Also, circular notes about economic substance do not generate basis. You cannot create basis by signing a note promising to pay your controlled corporation for stock when you haven't paid for the stock. You're not paying anything. That doesn't work. And personal and corporate finances have to remain distinct. Otherwise, we are going to into constructive dividend issues really quickly. So for all of that reason, this case is a textbook case of how to foul up. Clients need to understand, if we've set up a corporation, we've set up an entity, ignoring the legal potential consequences of doing it this way, because you probably have made it easier for somebody to attack this thing and pierce the corporate veil or get rid of the LLC protection, you've also made a total tax mess. They have to understand the mere fact you own 100% of the corporation does not mean you can just treat it like your own personal checkbook. You've got to show respect for the entity. And I will tell you, for tax purposes, you need to do that because this is what you get if you don't. But also go talk to your attorney and ask them about why it would be a really good idea for you to respect the entity. And I think you will get a nice long lecture about why you shouldn't be ignoring it. Right? I'm not going to go into details because, hey, like I said, I'm not an attorney. I don't practice law, but I will tell clients, I will tell you this much, there are legal consequences here. You better go ask the attorney about what damage you're doing outside of taxes when you ignore your corporation in this way. I want to make very sure I don't give any legal advice because, as I may have mentioned in earlier weeks, we have now moved into an office space And our office building is owned by the State Bar of Arizona. And literally, we right now, right at this instant, I think somebody else is moving into space next to us. But right now, we and the State Bar of Arizona are the only tenants on the ground floor. So literally, it's right down the hall. Is the organization that would start, asking questions about unauthorized practice of law. For me, somebody here in Arizona who is not licensed as an attorney. So I prefer not to be on the radar of somebody, especially not the radar of somebody who's right down the hall and who's our landlord. Just make that simple. So yeah, I have a good excuse to tell clients about why I can't do anything with them when they want me to tell them something about legal. And what's the legal treatment of this? It's like, sorry, I can't do that. And especially if they're in the office. Because see, right down there, that place you're going to pass, look to the left when you go to the when you go to the exit. Yeah, that's the place that can haul me in and I can have some trouble. If I were to do anything of that sort. So I don't want trouble with my landlord. So sorry, I can't help you with this. I can tell you to go get legal advice. Right? And you probably should, because we always, as CPAs, need to remember that there are more than tax consequences to transactions. And it's really important that we don't, because you can get yourself into a lot of liability problems if you don't have the understanding about why, in essence, advise people. I can tell you the tax consequences, but there are non-tax consequences. I do not advise you on that. So I can tell you the tax consequence of whether you want to organize as an LLC, let's say electing S, or maybe you want to organize as an LLC with a partnership structure. I really can't advise you on whether you should be an LLC if you're going to make a corporate election, or whether you should be an actual corporation. That is a legal question. It has no tax consequence, or very minimal tax consequences, but could have huge legal differences and liability differences. You need to go talk to them about that, right? Whenever we're talking about making entity selection, remind the clients that I'm talking about the tax side of this. There are legal issues, and you better go talk to counsel about legal issues. Preferably, we're all together talking about the combination of the tax and legal consequences. So this has been the Current Federal Tax Developments for December the 8th, 2025. Current Federal Tax Developments, as always, is brought to you by your state society CPAs and those of us out here in Phoenix with my firm, Thomas Dollars and Lynch. So, we'll see what's going on. I am doing some update sessions. I've done some for a couple of organizations. I'm going to be doing one this week, actually, for the U.S. Virgin Islands Society of CPAs, which is interesting because they are like 3 hours earlier than us. So I'll be starting them from 5 in the morning here. I'll do a broadcast from here in Phoenix. Definitely end early, right? Be a 4-hour session. It's actually on the One Big Beautiful Bill Act is my stuff there. But I've done a few others. I'm going to be doing a live session in Scottsdale this year. I've done sessions for a number of states and do sessions for firms. If firms want to have the updates, we can discuss arranging something through the state society or other ways to essentially get you an update course. And whether you want me to come talk with you in person, or you want to go ahead and just have it broadcast in, and I've done it. Right now, I got about a split evenly among firms about which way they want to do it. Just let us know. Otherwise, though, we will see you next week back here with more going on with current federal tax developments.